Thank you. All right, good morning, everyone. And gosh, it's good to see and hear all of you. And it's good to know that we're all well. So thank goodness for that. It's been a long time since we've had a meeting, since March. But let's go ahead and get it started. And we'll begin with a roll call.
Okay. You want me to do that? All right. Laura.
Present.
Landon.
Present.
Mr. Moore. Mr. Danny Covey. Mr. Mark Gardner.
Present.
Mr. Joel Hawkins. Mr. David Holly.
Here.
And Mr. Mark Munson.
Yes, I know Mark's trying to join.
Okay. Mr. Ashby. Mr. Challenger.
Here.
Mr. Glover. Ms. Gooden.
Present.
Rose. Thank you. And me. And of course, Ms. Terry. Is there anyone that I missed? Anyone that I missed?
All right, we have a quorum. Thank you so much. All right, we're going to move right along with the agenda. So we'll move right into approval of the minutes from March.
I'd like to move that they are approved as written.
All right, David has put the motion on the floor. Is there a second?
This is Landon. I'll second.
All right, all in favor? Aye.
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 Any opposed? All right, the minutes have been accepted. All right, Ms. Gooden?
There were no applications for the Portsmouth retirement system. For the fire and police retirement system, James Hoffler, he retired on July 1st. Matthew Giovanelli, he retired on July 1st. Manuel Rotolo, he retired on May 1st. As far as reported deaths and beneficiaries, there are 8. Gary O'Neill, Williford Owens, Alvin Harris, Robert Chapman, Sandra Williams, David Castell, Noel Dennis, Florence Kendall. Active participants for fire and police 11, for Portsmouth Supplemental 14.
Oh, that's a lot of deaths. Okay. We'll move on to old business then. Patty, you're up.
Okay, the worksheet that the finance department prepared shows all the months for fiscal 20. And I'm just going to highlight a couple of things rather than go over all the detail, but basically that we started off the year with $213.9 million. We have been paying out benefit payments, roughly 2.4 or so a month. The city has been making contributions. The regular contributions, in addition to including the $6.5 million that the city contributed from the savings from debt service refunding, totaled $17.7 million. And but with the gains and losses in the fund, we have an ending balance of $211.5 million at June 30, 2020, if you all can see that.
Mm-hmm.
And if there's any questions, I'll be happy to try to answer them.
Any questions on the historical funds report? Then we'll move right into the OPEB.
The OPEB, I attached the details of the report we get from Co-America, the trustee. And at June 30, there was $4,335,888.02. And I also wanted to highlight that I've included the OPEB board's annual meeting, which I believe is a virtual meeting. And they usually have a great speaker, and people can hear more about the plan, and that is September. And if anybody can attend that. So if any of you all are interested, you can sign up for September 25th at 10:30, and the Zoom information and stuff will be provided to you. So it's a nice event. When it was held in person, and I'm sure it would be very good in Zoom as well.
How do you sign up, Patty?
The information is included in this handout that is on the screen. So if you go ahead and get that, it'll tell you how to sign up.
Thank you.
And if you need any help, let me know and we can sign you up.
So this is Landon. I did attend that meeting last year in person, and I'd hope someone else would attend it this year via the Zoom meeting.
Yeah, it's very convenient not to drive the 2 hours to Richmond. So.
But if no one else can do, I think one of us should probably.
How long, Landon, how long is the meeting?
I think it was about a half a day, like 2 or 3 hours of the morning. This just says 10:30 a.m. I don't think it tells us how long it goes.
Right.
I don't see it either.
And
I'm going to put it on my calendar, and I'll try to make sure that I'm on the Zoom. That's the 25th, correct? Oh, you sent that earlier anyway, didn't you, Patty?
yeah, I did.
Yes.
It's in your agenda package. So.
Yeah. Okay. I got it.
And in the past, they would include lunch and so forth. So the meeting ended up being, fairly long. So there obviously will not be lunch at the Zoom meeting.
Okay. Is that it, Patty?
Yes, ma'am.
All right. Before we move to new business, I neglected to acknowledge Mimi Terry, our new CFO for the city of Portsmouth. And Mimi, if you have any introductions or words to share with us before we get into new business, please do.
Only that, I wasn't able to do the Zoom meeting. I have yet to meet everybody. And I appreciate all of the support that you all have been giving me. I think I started with in the midst of a pandemic. So it's just continued to move forward. I am so appreciative of Patty, Ms. Phillips, because Ms. Phillips has all the contacts. She knows everybody that when she came in to assist with the city financial reporting, she decided to stay on a little longer to assist me so I could get my hands around everything that was going on. And I know that I've asked her to help along the way. So I appreciate you all continuing to work with Patty as I continue to move forward in my position. And I know eventually things will be at some level of normal, and I'll be able to participate, see you all more, and be more available to you. So thank you in the meantime, and thank you all for the support.
All right.
That's it.
Thank you. Thank you very much. Now, before we move into new business, I know that at the end of the agenda is the election of officers. My term ends in September, and that's why it's on the agenda. And we should be done by 10 o'clock, but if after, we're gonna make the adjustment, and if it's okay with you to have Brian's report first, and because that's probably the longest one. And then if we need to adjust further after his report, we will, so that we can finish up by 10. Is that okay with everyone?
Yes.
Fine with me, yeah.
Yeah.
All right. All right. Then, Brian?
Great, thanks, Laura, and hello, everyone. Sorry, this has to be another virtual meeting here, but as you all know, we're in a new world. This is our new normal for a while, but it's good to see everybody and talk to everyone. I know it's been a while. Jim Whitney, who you know, is also online. Jim's going to cover our outlook in a few minutes, and Suzanne Lindquist from our OCIO group is online as well. She's going to help me talk a little bit about the portfolio, in particular some of the changes that we made as the chaos was ensuing in the late first quarter of this year, some of the shifts we made to take advantage of those opportunities. But as we go through this, please do ask questions. We're happy to address anything that's on your mind. So maybe Tom, if we can go to the next slide. Actually not sure exactly. Keep going. I'll tell you when to stop, Tom. Keep going. One more, right here. So go back one, Tom. Perfect. So here we're showing the returns of the major capital markets over various time periods. We showed July, and then next to July shows the full second quarter. We're going to talk a little bit about second quarter and year-to-date results and what's happened since then as well. But a lot of my comments are going to focus on the second quarter. You can see the S&P 500 during the second quarter was up over 20%, 20.5%. The market pundits are affectionately, maybe not so much affectionately, referring to this market as the Rip Van Winkle market. And the reason for that is if you look at the year-to-date return, this would be through July of the S&P 500, it was 2.4%. So if you went to sleep at the end of last year and woke up at the end of July, you'd see a U.S. equity market that's up about 2.5%. So nothing unusual about that. In fact, it might be considered fairly typical. But as we know, we didn't sleep for 7 months. We all lived through what was going on in February and March, and then the recovery that had begun to take hold really at the end of March of this year. So what's missed in that 2.5% return for the first 7 months of the year is the fact that U.S. equity markets in the first 6 weeks of the year actually were doing pretty well. We were up about 12 or 13% on the S&P 500. A lot of the momentum that we saw in the capital markets in 2019, you'll recall very, very strong returns in 2019, actually continued into the first part of 2020. But then in the middle of February, as the virus started to take hold in developed markets, starting really in Italy first, and then spreading to the rest of Europe, and then eventually coming on shore in this country, markets sold off precipitously. In fact, from about the middle of February to March 23rd, the U.S. equity market was down about 35%. And we were right in the middle of it the last time we got together. The market hadn't quite bottomed at that point. But what the Federal Reserve had done and the White House and Congress had done from not only a monetary policy perspective with cutting interest rates to zero and implementing various programs to support the banks and credit markets in particular, and then with the follow-on of fiscal stimulus that was coming through from Congress, the government here in the United States has shown a propensity to throw as much money at this problem as humanly possible to try to stabilize the economy, try to stabilize capital markets, and get us back on a path to growth. And in response to that, we saw a dramatic rally off of the March 23rd lows. So we were down from peak to trough in the decline about 35%. Since the market bottomed on March 23rd, we've seen a 46% rally. So, and this is through July, and the first part of August, the first half of August, we've seen continued rally in the equity market. So again, if we went to sleep for 7 months, you wouldn't know anything happened, but in reality, quite a bit happened. We had a raging bear market and a raging bull market within the span of a few weeks of each other. So we're going to relate that to some of our comments as we talk about the portfolio, but just to put all of that sort of into perspective. If you broaden out the view away just from large cap US stocks as represented by the S&P 500, you could see some of the other market returns below that. I'll go down to the Russell 2000 index. That's an index of small cap stocks in the US. The second quarter's return there, 25.5%, even better than what we saw in large cap US stocks. Now, they went down a lot more during the decline in the first quarter, which is why they were, at least at the end of July, still down about 10.5% on the year, but a significant rally from small cap stocks. And as we go down from there and look at non-US equity markets, the Msci EAFE index, that's an index of developed market countries, think Europe and Japan, up about 15%. Like small cap stocks in the US, still down on the year. And then below that, the MSCI Emerging Markets Index up 18%, and roughly flat on the year through July, down slightly. So the rally that we've seen in the second quarter of this year was really nothing short of extraordinary, driven very much by the policy actions that have been taken by the Federal Reserve and the U.S. federal government to get people money and money in the hands of people to support their expenses and lifestyle, and it was very much needed given the fact that economy shut down for a period of time, people were out of work. So you look at the headline economic numbers and it looks pretty depressing, but the policy response has been nothing short of extraordinary, which has caused the market to bounce. The issue I would say that the market is grappling with at this point, and this will sort of get into our outlook a bit, is the fact that as various states have started to reopen their economies, the infection rates have started to increase. And so that's causing some to think that, maybe this equity market has gotten a little bit ahead of itself. We actually don't fall into that camp. And Jim's going to talk about what our outlook is, but we strongly believe that the political will to shut the economies down at the state levels again with a second uptick in infection rates is not likely. So whereas a lot of states, certainly here in Illinois, California, all over the country had basically shut their economies down the first time around, we think that's unlikely to happen the second time around if we get this sustained rise in infection rates. Tom, maybe if you can just flip ahead to the next slide, I'll just give you a couple of comments on fixed income markets. So fixed income markets this year have been strong, and particularly
Brian, this is David. There have been some talking about what you were just talking about that have suggested we may have a correction within the next 30 to 90 days. Did I understand you to say that you folks don't agree with that?
Well, I don't know that I would go that far. We do believe that the markets may very well have a short-term pullback. In the range of, call it 5 to 10%.
Right.
But we certainly don't see a dramatic decline like we saw in February and in the early part of March of this year.
All right.
And the reason for our belief that maybe we get a short-term pullback here is simply a function of the fact that we've gone straight up since March 23rd. And typically, you don't have this strong of a rally in as short of a period of time without some retrenchment
Gotcha.
or retracement.
Right. Okay. Thank you.
Jim or Suzanne, would you sort of add anything different on that?
No, I think that, I think that you're right. I think that that there are, a number of things, as Brian said, to support where we are today, including what the Fed's action, as well as the fiscal action as well. But there are a number of things that could create, albeit just the level of markets, a correction over the next 60, 90 days, including just the fact that we're going to be entering election season, that we're going to be changing changing seasons, and the anticipation of maybe a tick up in COVID, are some of the things that might create some volatility and a correction. So I don't think we disagree with that. I think the long-term perspective for markets, given what the Fed has done, is still pretty, I think we're sanguine on that. I think Jim probably would have more to say too. So I think that there is definitely room for interim volatility, given kind of the landscape of what we have from a election, and as I said, from COVID and whatever else sort of globally, comes into play.
Thank you.
Hey, this is Landon. I got a sort of a follow-up question to that. Does your sort of base case assume the Fed is gonna, or excuse me, we're gonna get another round of stimulus, and then also, regardless of that, are you expecting a lot of volatility around the election time?
Well, let me take that one, Landon. So the answer to an additional stimulus package is absolutely yes. That is embedded in all of our analysis, and we think that we will see something come out of Washington. And then as it relates to this question about correction volatility, at this point, there's a report that is attached to this deck. I think it's later in our presentation. It's called The Danger Zone. It's written by Andrew Sheets. And he does some very interesting work. His point is expect some volatility in the next couple months, and some of these points were already discussed by Brian and Suzanne, but we wouldn't be at all surprised to see a 10%, even more 10 to 15% pullback. Nothing unhealthy about that at all, given the extraordinary rally off the lows we've had. And the reasons are, of course, some volatility around the election, seasonality. Stocks tend to be a little bit weaker at this point in the year. And the big reason is that all of the stimulus, in this last package, which we believe will get passed, gets passed, there's this absence of good news. And there's been a massive amount of positive news. And I'll cover some of this during my formal presentation. So kind of a little bit of an air pocket with good news could easily leak into a correction.
Jim, maybe this is a good time to go to Outlook. You can see on this slide just the returns of the fixed income markets. Obviously, interest rates are on the short end of the yield curve, effectively zero, very close to zero. 10-year Treasury yield at 53 basis points at the end of July. Interestingly, if you looked at the TIPS market, so Treasury inflation protected securities, the yields on those are actually negative. So this is what the Fed is hoping for, that with interest rates so low that money will flow into equity markets, and we sort of have some asset price inflation. They've really been trying to accomplish this since the end of the global financial crisis. And it seems to be happening certainly, over the last several months. But fixed income rates have been quite good, or returns have been quite good this year. I know Suzanne later is going to talk about a move that we made in your portfolio into high yield bonds, but we'll save that for later. So Jim, maybe now's a good time to go into Outlook.
Right. Thanks, Tom. So if you can go back one, I'll just do a quick summary here. So I think this first point on this slide really sort of sets the tone and stage for our view. And I just want to highlight these reasons why we remain bullish on equities despite this conversation about a potential correction. So we have, as you'll see in a few minutes, we've been very bullish on equities and have been in the V-shaped recovery camp. I know that's been controversial for a lot of strategists, but our view is that the health crisis that triggered this recession brought an unprecedented amount of monetary and fiscal stimulus that we just wouldn't have otherwise seen. And we'll look in the next couple slides at the order of magnitude of this support. And then importantly, the political pressure behind the reopening U.S. economy is going to make this a little bit faster, a little bit more durable than I think most people anticipated. And this is true even if there's a second wave of the virus. It's very unlikely that we're going to go back to a lockdown on businesses. The implications for businesses, both small, medium, and large, particularly the small and medium, it's really devastating. And then I think the final point is that we see some really, really bearish retail sentiment that helps support the market in our view, because these retail investors will eventually turn. And it's surprising to us at up 40% that they haven't started to buy equities. So let's move to the next slide. And this is V-shaped recovery is probably the most important slide in our Outlook deck. And this first chart shows how severe the recession was in terms of the depth. It has been extraordinary, much deeper than the 2008-2009 great financial crisis. So this is going to be one of the deepest recessions we've ever seen. However, a V-shaped recovery is what we've been calling for. Yeah, we might see a fade after the recovery for different reasons, but we're going to experience a very sharp recovery in our view. And the reasons behind this view is government policy. So let's move to the next slide and start with fiscal review. So you can see this fiscal response is as a percentage of GDP, and it's here you see the fiscal response is negative 24, 25%, and we haven't seen anything like this since World War II. We didn't see anything like close to this during the Great Financial Crisis, where we only got about 8 to 9% of fiscal deficit. Even during the Great Depression, we never really got anywhere near this kind of support. So this time around, we think we are all in, and it's one of the main reasons we think the recovery will be sustainable. And you'll see, well, let's go through the next slide first and cover the monetary policy. Okay, thank you. So on the monetary side, this slide shows the Federal Reserve's balance sheet over time. It's very clear that this is not just fiscal support, but monetary policy as well. And the expansion in Federal Reserve balance sheet is going to be triple the size of the Great Financial Crisis. So the speed in which these policymakers have acted and the size of the policy is truly unprecedented. And it's going to get us through what we're in now, which is a fairly deep recession. So if we look at these last two slides, monetary and fiscal policy, I'm sure all of you probably have had questions or heard about, well, the stock market yesterday was just a whisper away from a new all-time high. And it seems like the stock market is really disconnected from Main Street, or we've heard this, disconnected from reality. And indeed it is. If you look at the number of people that are unemployed, filing for first-time unemployment, bankruptcies, it's really tough in Main Street. There's no question about it. But remember that the stock market is a discounting mechanism, and it's looking out 6 to 12 months, and investors see a much brighter forecast on the horizon in 2021 and 2022. And the support on the monetary fiscal side, the charts that I just showed you, are unprecedented by any measure. And investors look at this level of support as sufficient to get us out of this recession. And it's not only the order of magnitude, it's the speed at which it was delivered. So the money got into the hands of consumer and businesses. Sure, it wasn't perfect, but it was an awful lot of stimulus, and the stimulus will get us to the other side of this recession. And if I had to explain why there is a disconnect between Wall Street and Main Street, it is the anticipation of the stimulus resulting in a much brighter economy in 2021 and 2022. Not to mention what would happen if there's a vaccine later this year. Next slide, please. So this is a slide of economic data surprises. This is a proprietary set of indicators we use at Morgan Stanley just to gauge how healthy the economy is and directionally how it's moving. And what you see here is the surprises that we have witnessed are very consistent with the stock market recovery. So we've seen a lot of positive surprises. And remember, these surprises can just be as simply as the rate of change in change. So it doesn't have to be a really robust number, but the delta, the change in the rate of change can be positive to drive this indicator higher. So when we look at economic surprises, it's really almost off the chart in terms of how quickly the economy recovered and supporting this V-shaped recovery that I talked about earlier. Next slide, please. We find this next slide quite interesting, and this is prices for S&P 500 tracking the 2008-2009 Great Financial Crisis. And at the top of the slide, we're looking at the light blue line is the S&P 500 in the 2009 period, and the dark blue line is S&P today. So it's not perfect, but you can see that returns do start to normalize in a fairly tight pattern. And it's not just unique to the S&P 500. At the top of the slide, we can also see this same correlation between small cap stocks in the Russell 2000 today, again, the dark blue, and then versus the 2009 period. So it's not a straight line. You can see there's some air pockets along the way, but we do find it quite interesting how it's tracking the 2009 crisis. And as we just saw, the amount of stimulus in the 2009 crisis versus today is quite different.
Zero. Yeah.
Next slide, please.
Yeah. Right.
We get a lot of questions about the health of the recovery.
Hey, Jim, it's Landon.
Landon.
Just a quick question about the previous slide.
Yeah.
The 2009 wasn't in, maybe your chart doesn't go far enough. Wasn't there another pullback the next year, I guess? Or is this missing something? I thought there was a sort of a second dip with the financial crisis. Maybe I'm wrong.
I think there were a series of dips, but off the lows in March, they were modest in comparison. Yep. So I think what you're seeing some of those dips, but they just weren't nearly as dramatic. Yeah,
Okay.
you're absolutely right. There was a pretty sharp sell-off, and it might even be visualized.
Yeah, this is just
That's late March, early April.
a month. This is just a year. This is not.
Okay. Sorry, I'm derailing the
Oh, no problem.
thing here.
So this next slide, you do get some questions about the weightings of certain stocks in the index and whether the S&P is being driven or marketed at whole is being driven by 4 or 5 big, well-known technology companies. And the answer is yes, it's having an impact, certainly on the S&P 500. But when we look at the bottom of the sell-off in the market this year, in March, it looks to us like there's fairly broad participation. So the first chart, we're looking at the Russell 2000 small cap stocks relative to larger brethren in the S&P 500, and you do start to see small cap stocks starting to outperform the S&P after the March low. And then if we broaden it out to the Wilshire 5000, which is effectively the U.S. investable universe versus the S&P, we see that there's broad participation there. When we equally weight at the bottom, the S&P 500 versus its natural cap weight, story is a little bit different, and that's partly driven by the heavy weighting in the top 4 or 5 tech stocks. But as a whole, we think the rally's it's pretty broad and healthy, and we're not worried about it being driven by a couple of technology stocks. Next slide, please, Tom. So this is a lot of data points on a slide, but effectively what we're seeing here is we're measuring retail bullishness or bearishness, and one of the measures we use is the AAII, American Association of Individual Investors. They have one of the longest measurement periods in the industry in terms of the bullishness or bearishness of the retail investor. And what both of these charts are telling us is that the retail investor is still quite bearish. So the retail money a lot of that money is still sitting at the sidelines and has yet to come into the market. And this is really surprising for us because, market, as Brian mentioned, is up now over 45%, measured through today off the lows. And that it's really late for the retail investor to get on board. And there's a couple of reasons for that. This virus is still raging. It's still actually increasing in certain parts of the country. And this has the retail investor very retrenched and very nervous. And the second wave is unknown. So you can understand it. And it's also the virus is also a personal attack, right? It's a personal attack on an individual's health, and that can severely constrain the enthusiasm for stocks for the retail investor. But in the end, this results in additional money on the sidelines. We think at some point we'll rotate out of cash, which has virtually no yield, or fixed income, which has a dramatically compressed yield and not much better return dynamic versus cash.
So this is Landon again. I think y'all presented a chart back in, maybe it was February, the last time I was at a meeting, that talked about the retail flows and how they, you showed something showing how the retail flows really corresponded with returns, and that 2019, basically the setup for 2020 didn't look good for retail flows. So I guess that played out even in the midst of coronavirus. Is that, am I remembering that right?
Yes, the retail investor had moved substantially from the sidelines prior to the pandemic into equities. So the retail flows had supported the rallies that we saw prior. Now, of course, that has changed in terms of their bullish bearishness in a pandemic. So it is manifested itself, and then it is unwound, and now we've got a lot of retail cash on the sidelines we think will be available for purchase of equities vis-a-vis other asset classes.
Do we know sort of how the retail, how does the amount of money in retail compare to institutional? How big is it? I mean, how much do retail investors move the market?
I think it is dominated by institutions. I've not seen any particular ratios on institutions versus retail cash. But when you think about, we've got 401ks, pension plans, endowments, foundations. That's a lot of capital. But that's a very good question. I'll see if I can get a more specific answer. My sense is it's dominated by institutional investors.
Because especially in the days now of Robinhood and all that kind of stuff, and there's a lot of talk about retail investors and millennials, all about these growthy tech stocks and stuff like that. But I don't have any context of what that means, if how much money those retail investors really have and how much impact or influence they have on the overall market.
I think the media has certainly been focused on millennials working from home and becoming day traders. Mm-hmm. We've certainly seen that amplified in individual stock movements, particularly companies that have filed for bankruptcy and their stocks are up 30-40% because other people are buying it, but it is effectively a worthless security. So it has certainly amplified individual securities, this day trading as a number of people try and trade from home. But in terms of moving the market to where it is today, which is in S&P 500, which is an enormous index, it takes an awful lot of capital to do that, and I think that has to be driven by institutions.
Okay.
But I'll try and explore that more deeply for our next meeting. Any other questions? So just to close, to be clear, we were one of the first firms to call for this V-shaped recovery. We saw the extraordinary amount of monetary and fiscal stimulus that was being put into the market that helped underpin our views. We thought analysts in the first quarter had dramatically slashed earnings estimates for the rest of the year and for 2021, and we thought that was way overdone. There was a lack of understanding of the operating leverage in some of these companies. And as a result, you'll see in a few minutes, we've made some portfolio shifts as a result of our views on capital markets.
Great. Thanks, Jim.
Okay. Brian, I'll turn it back to you.
Thank you. I'm actually going to, Tom, maybe have Suzanne pick it up from here, talk a little bit about kind of what our exposures are right now, and then I'll get into some of the results after Suzanne. So, Suzanne.
Sure. Excuse me. Good morning, everybody. I think, Tom, you can pass it to the next page, or we can just reiterate that this page, the previous page, was just a summary of our mandate in terms of benchmarking and objectives. On this page, what we've done, certainly in light of what Brian has talked about in terms of the volatility in the markets, the dramatic drawdown, and then the sort of V-shaped mini recovery or major recovery that we've seen since late March or early April. We've made a lot of switches or a number of switches to take advantage of what we think makes sense for the portfolio given a lot of what Jim has said from an outlook perspective. As he's pointed out, we are long-term bullish on the market. We were, and our firm was correct in thinking that the risks to the market were misunderstood and valuations or estimates for valuations were dramatically reduced. I think we recognized too that in the space of just several weeks instead of several months, what was done from a fiscal and monetary policy perspective was astounding. Recall in 2008, for many of us who were in the market at the time, the programs that were put in place took many, many months for that to be worked through the system, and as a result, the crisis stretched out over a period of a year to 18 months. This time around, it was about 6 weeks. Programs like the TALF program, which is a program to support certain parts of the market and investor base. Among other programs, certainly the monetary stimulus, like simply cutting the interest rate for the Fed, the Fed funds target rate, as well as making funds available to purchase certain parts of the market, really helped buoy valuations, and in our mind continue to support a perspective certainly for certain parts of the market. Just in summary, some of this may have been reported at the last quarterly meeting. Recall in early March, during the mayhem, we saw a dramatic flight to quality. What that means is people tend to retrench and buy what they know is going to preserve principal and capital. That typically is interest rate related securities or treasury related securities. So as a result, I think coincident with the monetary policy shift to zero, and certainly in anticipation of that, the treasury market and high quality bonds went up a lot in price as a result of falling interest rates. So, one of the major shifts that we did immediately was to recognize that longer term high quality bonds no longer offered upside protection or essentially ballast to the portfolio. And we decided to reduce our exposure to those securities, investment grade bonds, and effectively raise cash as a buffer for continued volatility initially. And that was one of the major shifts that we made toward the end of the first quarter in the midst of the volatility and when things seemed much more uncertain. Subsequently, we redeployed those some of those proceeds, and you won't see it in this chart because this is really just a recap of the first quarter. We subsequently redeployed some of those proceeds into large cap equities. As Jim and Brian have talked about, these types of instruments had been in a way, place where capital was deployed when people were less certain, and we knew that part of the market would recover first, and it did. On the chart that you're seeing in front of you is really an illustration of the benchmark up top and how it's broken down by the major asset classes: equities, fixed income, hedge funds, and private real estate, as well as cash, which is important, and how the portfolio looks from an OCIO perspective today. Below that, we have included a table that again repeats the percentages that are represented by each of those asset classes in the benchmark, our exposure from an asset allocation perspective, and then the initial target weight. Importantly, I think instead of having to review this eye chart of numbers, we gave you a table that looks at where we're neutrally weighted, where we're sort of overweight, and where we're underweight in the portfolio. Today, I think was there a question? Today we wanted to highlight some of the shifts that we made within this quarter. But before I do that, I'll just highlight where we remain somewhat overweight. Given Jim's comments and Brian's comments earlier, we remain somewhat overweight in the equity subsector of the portfolio. We have about 71% relative to the benchmark of about 70%. But that doesn't really tell the entire story. Within our portfolio, we have shifted some of the passive strategies that we had to benefit from a resurgence in pricing in the equity market to U.S. mid-cap stocks and small-cap stocks, which we feel really are going to benefit from the liquidity that has been pumped into the system, as these companies will be effectively direct beneficiaries of that liquidity. We also believe that they will benefit from a shift toward deglobalization. We know and recognize that in that particular sector, of stocks. In fact, I think generally speaking, active management is going to be where we want to be. We think that while the 5 or 6 stocks that tend to dominate the market headlines, the opportunity is going to be hiring managers that will be much more selective in their respective asset class cohorts, looking for securities and looking for stocks that are undervalued relative to similar compares. I think Brian's going to talk much more in more detail about the 2 managers that we're using in the U.S. mid-cap component, Rice Hall, James, and Delaware. Both managers we have a high conviction in. As a pairing, they make a lot of sense. Where one will sort of outperform in an environment where we see stocks generally rally, the other will provide some ballast when the market reverses, which might be something that we see, as we said, early or in the next 6 weeks to 8 weeks, depending on the election. Within the fixed income markets, I mentioned that we had shifted out of your core strategy, out of core bonds, given the level of interest rates. Recall that the Fed funds target rate or short-term securities yield about 0. And subsequently, while the curve is somewhat reshaping, the long-term securities are only yielding about 135 basis points. And so what that means in an environment when rates go up even a little bit, long-term securities begin to generate negative returns. So in searching for opportunities that are similar to the small cap and mid cap stock opportunity, which is certainly an active strategy, we have initiated a position in the high yield market, where the rate exposure tends to be somewhat smaller, right? Bonds tend to have interest rate exposure of about 2 or 3 years. Therefore, they can withstand a shift toward higher rates, which we expect over the course of the next several years, while enjoying a yield premium that is in excess of 400 basis points. Recall when we made this shift or we initiated this position, much like when we initiated the position in small cap stocks and the position in U.S. growth, valuations were much lower. So putting it into context, the high yield market, when we bought this position, had a spread, meaning a spread over treasuries of about 750 basis points. As I mentioned earlier, we're now somewhat around 475 basis points. So we've generated some significant return on the position. And it's a position that we continue to like for the same reasons. I think we continue to like SMID. We continue to like certain elements of the active sector within equities. Finally, I think from a rebalancing perspective, we have initiated a position in Oak Street, another income generative strategy. This particular real estate strategy focuses on very high quality real estate investments through triple net leases, which really relieves them of some of the maintenance costs and other elements of real estate. Again, this is high quality, income generative, and we think that this will actually be supportive of the overall portfolio and consistent with the thematics that Jim laid out, which is generally a V-shaped recovery. Much of it is contingent on the continued support of monetary policy, more support from a fiscal perspective, and just really a recovery and a refocus once we can say goodbye to COVID. And that while volatility may pick up toward the end of the summer and as we go into the fall, it could be relatively short-lived. And managers can take advantage of relative opportunities in either the bond market or in the equity market, instead of necessarily focusing on a particular segment, are able to rotate between industry sectors, are able to rotate between market capitalization, will actually pay off more than it has in recent years. So with that, Brian, I can pass it over to you.
Great, thanks, Suzanne. Any questions on sort of positioning and some of the changes that we made? Okay. Let's get to the good stuff. Tom, maybe next slide. So here's where the rubber meets the road. Very, very strong equity market returns in the second quarter, portfolio positioning. Maybe Tom, go down a little bit further so we get the returns there. Here's how we did. So the first column there is second quarter. So this is through June. It doesn't include July. I'll give you a sense as to sort of how July looked, though. We were up in the second quarter about 16%, 15.98% on a net of fee basis, net of investment manager fees, net of our fee, net of all costs. The benchmark was up 14.3%. So we outperformed by over 1.5 percentage points. So very, very strong result. We'll go through some attribution on what's driving that, but we are very pleased with how the second quarter developed in terms of the returns we were able to generate for the city. You look at the first 6 months of the year, the numbers are still negative through June. We're down about 2.1, 2.2%. Nobody ever likes to be negative, but we were down less than the benchmark's return of -3%. So anytime you can go down less, that's a good outcome. And then if you move all the way over to the far right-hand side of this table here, this is the custom period, which is October 31st of 2018 through June of this year. This is reflective of the discretionary mandate that we were hired for in the fall of 2018. On an annualized basis, we're up 9.9% versus 8.1%. So results very, very strong across all periods. If you looked at the month of July, July's returns continued to be positive. We looked at that when we talked about the major capital market returns. The first half of August is pretty strong as well. Maybe not as strong as July was for equity markets, but we're still positive. I just did a really rough back of the envelope sketch for July before this call for us. We're going to be up somewhere between 4 and 4.5%. So if we roll this data and this information forward to the end of July, we'll be positive. We'll have a positive return on the year, given that July markets were so strong. I know at the sort of city council level, there's been a focus. I just want to, on investment results, I just want to, call your attention to that middle table there, which shows the investment earnings. So in the second quarter in dollars, we were up 16% in percentage terms, but in dollars, that translates into $29 million. Over that, roughly 1.5 year period for that custom period, we're up $32 million in terms of what the investments did for us. So again, very, very strong results on a total portfolio basis. And a lot of that has to do with not only some of the active managers we have, which we'll talk about in a second, but some of the shifts we made at the tail end of the first quarter and then into the second quarter of this year, as Suzanne discussed.
Brian, this is Mark. I just wanted to say thank you. I believe this is the slide that City Council should see that shows the wisdom of what we did in giving you guys the discretion to manage our portfolio, especially as we stepped into this mess.
Well, thank you, Mark. And I will just, all the credit goes to this board for the focus it had on the portfolio back. Even before we took discretion, we made a significant number of changes in working with the board back in, late 2016, early 2017. And the decisions that the board made back then are really playing through with the new mandate we have from the fall of 2018. So we appreciate, Mark, those comments, but we would be remiss without, applauding this board for its vision and the decisions that it has made over the last several years. Maybe Tom, if you can flip ahead to the next slide, and if you can scroll down a little bit. So here's some attribution for the second quarter of this year. And the way to think about this chart is, I'm going to talk about the bars on the top of the page here. So if we did nothing but invest passively, based on our asset allocation strategy, which is basically 70% equities and 30% bonds and alternatives, we would have earned a return of 14.37%. Now, if you move all the way to the far right-hand side, we actually earned this is on a gross of fee basis, so not net of fees, but on a gross of fee basis, we actually earned a return of 15.91%. So we want to the extent we can, break down the difference between that 1437 and that 1591. And there's really three different decisions that can be made. One is what we call broad asset allocation effect. I'll describe these in a second. The second is called sub-asset allocation effect, and then the third would be security selection. So the way to think about the broad asset allocation effect is, we have these broad policy targets of 70% equities, 30% bonds and alternatives. The practical realities are that we cannot be exactly on those percentages every single day of the quarter. So to the extent that we hold a little bit more in equities or a little bit more in bonds, or in this case, held a little bit in cash so that we could meet the benefit payments, that had some impact. And the impact that had, largely holding about 1% of the portfolio in cash to meet benefit payments, was that it detracted about 27 basis points from return. So that's what that broad allocation effect is. Now that sub-allocation effect touches on what Suzanne talked about earlier. So although we have a broad 70% equity target, part of that is going to be large cap stocks and small cap stocks and US stocks and non-US stocks, emerging markets. Did the slight differences in those allocations within the equity markets, for example, what impact did that have? And it resulted in a slight detraction from performance, about 31 basis points from performance. And there's really a couple of reasons that were driving that. One, you may recall heading into this mess, we had an overweight to value stocks that we've corrected. But we did have a slight overweight to value at the beginning of the quarter. We as the market sold off in March and the valuation levels of growth stocks got cheaper, we undid some of that overweight, or we undid all of that overweight to value stocks. But we did have a slight overweight for a portion of the quarter. The other thing I would say is we do have a dedicated allocation to a manager that focuses on Japan. And Japan, in the second quarter, underperformed the broad non-US equity markets during the period. So the impact of those two exposures mean it hurt us a little bit. It detracted about 30 basis points from our return. Now we talk about the selection effect, and what does that mean? Did we have good managers? Did our active managers beat the returns of their benchmarks in the second quarter? And you can see that's where all of the excess return comes from. So on a manager selection basis and on an individual security selection basis within those portfolios, in total, those managers added over 2 percentage points of value. So you sum those three different numbers, and that equals the difference in return between the benchmark and what our actual portfolio's return was. So any questions about that before we get into, I just want to spend a couple of minutes on individual portfolio returns.
This is Landon. I'll just comment that, from what I've seen, it's been hard to get that 2.11% from security selection recently. And not a lot of others have been able to achieve that. So that's a really good job.
I will say this is a period that hasn't favored active managers. So to generate the kinds of returns through our active manager selection has been great in a period where, in general, though, that exposure hadn't paid off. But you're absolutely right, Landon. It's been a tough environment for active managers more generally. Fortunately, we've had some pretty good ones. Maybe if there are no other questions, Tom, maybe if I can ask you to go to page 41 in the interest of time. I know there's a couple additional things that the board has to cover, but I just want to touch on a couple of things. So here are the results of all of the individual manager returns. And as I mentioned, manager selection accounted for over 2 percentage points of the value that we were able to add at the total fund level. And I'm going to point you to two portfolios in particular that were really generating that result. Halfway down the page is something called the Artisan Developing World Fund. We've talked about this manager in the past. It has done exceptionally well. So even though it's in a market, emerging markets, that you certainly haven't done as well as the US equity markets, this manager's return during the first 6 months of the year is almost 38.5%, beating the benchmark by about 20 percentage points in the second quarter. You look at the 6 months of the year, they're up 27% versus an index that is down 10. So extraordinary performance. This is a manager we've had not only since the beginning of our discretionary relationship, but even before that, we had, this was one of the changes that the board made back in, I think it was late 2016 or early 2017, to initiate an allocation, a dedicated allocation to emerging market stocks through this manager in particular. And again, since that discretionary relationship, this portfolio is up 44% versus an index that's up about 5%. So just to say that these results are extraordinary is an understatement. In fact, of the 211 basis points that security selection added, this manager accounted for about half of that, even though they only manage about 5% of our money. So worth pointing out that portfolio in particular. The other portfolio that did quite well in the second quarter is a couple of rows above that, the American Euro-Pacific Growth Fund. Again, this is a manager that we've had for a very long period of time. They were up almost 23% in the quarter versus a benchmark of 16. You can see they're down on the year, a little less than 5%. Again, nobody likes to be negative, but to the extent that we can go down only half of what the index has gone down means we don't have to be up as much to get back into positive territory. This is a fund that has continued to do well into July and the early part of August. So we feel, really good about that exposure as well. Two more portfolios I want to touch on, and happy to address any questions. In the past, we've had a lot of conversation around Rice Hall James. You can see that towards the bottom of the page. This is a manager that we've had a significant amount of internal discussion around. We've had a significant amount of calls and meetings with this managers to get our arms around whether this is something that we wanted to stick with or move away from. You can see the longer term returns over that custom period are bad. There's no getting around that. But this is a manager that Suzanne touched on earlier that we have a very high level of conviction in, largely because that underperformance historically being attributed to a lot of the biotech stocks in particular that they didn't own that were merger and acquisition targets. So that's what's driving such a strong benchmark return. This is a manager because they focus on quality kinds of companies that have actual earnings and revenue growth that just simply are not going to buy those kinds of companies. It's driving a lot of the underperformance. We actually committed additional assets to this manager during, I think it was May or June. So we gave them additional funding, and that seems to be paying off. We were up about almost 37% for the quarter, and that was roughly 4 percentage points greater than the benchmark. So this is, I know it almost sounds counterintuitive to give somebody more money that has underperformed so dramatically, but in our view, that's the exact time to be adding capital. To the extent that there's nothing that's changed with the process and we still think highly of the manager, that's when we want to commit more capital, and that's what we've done in May and June of this year. One more comment on a manager. I'm going to go back up towards it's about a third of the way down on this table, Lazard International Equity. This is a firm that has underperformed. It certainly hasn't underperformed as much as Rice Hall did, but this is a manager that focuses on value-oriented stocks. We talk a little bit about growth and value. Value-oriented stocks have done poorly for an extended period of time. So I think some of that underperformance, and we believe some of that underperformance, is a function of the manager style. That being said, this is a manager that we are likely to be moving away from in the next, let's say, week or so. And we are, at this point, identifying a suitable replacement for this portfolio, something that pairs nicely and is a complement with the other non-U.S. equity managers that we already have in our portfolio. So the next time we get together, don't be surprised to see this portfolio gone and a new one in its place. Our intent is to still look for a manager that has a value investment process, but maybe not as extreme focused on value as this portfolio is today. So with that, I'm going to stop, see if there's any questions. There's some other active managers on the following slide. Again, the results have been very, very good. We're very pleased with how the portfolio has performed, how it looks, and how it's positioned based on our outlook for the future.
Brian, thank you for that summary, and I'm glad we hung in there with Rice Hall James. Looks like it paid off. And I do appreciate the fact also that you're looking at underperforming managers and seeing what we can do to get a replacement there. If we can, we have some board members who need to leave at 10, and we want to have as many board members present as possible during our elections. So right now we're going to take a pause and go to that part of the agenda. And Mr. Challenger, if you would lead that discussion, I'd appreciate it.
Okay. You said, what's the question?
Okay, we are, if we're looking at the agenda, the last item on the agenda is elections of officers.
Yes.
Yes, my term is over, and so we're going to need to elect a new chair and vice chair
Okay.
that will begin serving at the next meeting. And before we start, I just want to say what a pleasure it's been to work with all of you and to see our results come into, such growth. And we certainly do appreciate the leadership from Greystone for that. So with that, Mr. Challenger, if you would, and then if there's any further comments from Brian, we'll go back to you and then we'll wrap up with Tom.
In reference to the election of the, I looked at the bylaws as well as the city code. And in terms of the bylaws, I think it pretty much addresses it. It says all officers, except the executive secretary and fiscal officer, shall be elected at the annual meeting of the Board of Trustees, with the chairperson and vice chairperson elected by the membership of the Board of Trustees. All officers shall hold office for a term of 4 years or until their successors are elected and qualified, up to a minimum of 2 terms of office. And so that's the part that's relevant for the election. So that's pretty much the standard for it.
Okay.
So that the chairperson and vice chairperson is elected by the membership of the Board of Trustees, and that the term will be for 4 years.
Okay, thank you. So with my term ending, then we are definitely open for a new chair. I'm opening the floor for anyone any nominations.
I'd like to nominate Landon.
Is that you, David?
It is, yes.
Okay.
I would second that nomination.
And that's Mark.
Yes.
All right. Any other nominations from the floor? Landon, would you accept the position if offered?
Yeah, let me just, I will, but Derek, is this being appointed chair, does that starts a new term? Is that what you're saying, a new 4-year term? So I think I'm currently in the middle of my 4 years. Is this pushing it out another, am I sort of committing to another more time?
I don't believe so, because I think if you read the next sentence, it says all officers shall hold office for a term of 4 years or until their successors are elected and qualified, up to a maximum of 2 years of office. I don't believe that you can, because the officers have a term of 4 years, and so I don't think you can. That would in essence create you being there for longer than the term that you have. So I think you're only able to serve out whatever your term is. I don't believe you add additional time beyond your 4 years.
Okay. Yeah, that's fine. I would love to do it.
All right. Then is by acclamation, you are our chair, or do we need to officially vote? All in favor? Aye.
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 Any opposed? No. All right. Thank you, Landon. And next we will need a vice chair. Any nominations from the floor?
I'd like to
This
nominate,
is Mark. I would,
go ahead.
this is Mark. I would nominate David.
Well, I was going to nominate you, Mark.
Well, I was looking for a staggering of the change in leadership because I'm on the same cycle as Landon is.
Okay, so you have 2 years left?
Yeah.
Okay, I think I've got to check, but I think I only have 2 years left as well. Would anybody have that information ready, available?
I do not.
Okay.
I do not.
We can get that, but not at this instant.
Okay.
So, whatever your term is, I'm just suggesting that, if your term is up, your term is up, and you serve in the interim.
All right. So are you willing to serve, David?
I will serve if yeah, I'll do that. Yes.
All right. Mark, you were nominated as well.
How about I say I nominated David. So.
All right. So you withdraw. All right.
Yeah.
All in favor of David as vice chair? Aye,
Aye.
please.
Aye.
Aye.
Any opposed? All right. Well, congratulations, Landon.
Thank you very much.
And David. We appreciate that very much. And with that said, let's just get back to the agenda. And
Hey, this is Landon. I have to run to another meeting. Thanks, everyone. Laura, are you going to be at the next meeting? Do you have one more meeting left? If we have
I
it.
will. Yes.
Okay.
I will.
I'll yeah, we'll talk again then. Thanks, everybody. Bye.
All right.
See you, Landon.
Bye now.
Landon.
All right. Let's see. Brian, were you done? Or did I cut you off?
I am. Yes, I am. Thank you.
All right.
All right, Laura, do you want me to give a quick update?
If you would, I appreciate it.
Yeah, certainly. So happy to do so. And I'm sharing the screen again, so hopefully everyone can see it.
Yes.
Excellent. So I don't have a significant update for this quarter, and in the interest of time, let me just make a couple of comments and highlights, and then I can see if there's any specific questions, but folks can review the material if they haven't had a chance to, and I can take follow-up questions after the fact if needed. So just kind of with the continuation of the ongoing support and updates that we provide from the rest of the service team at John Hancock. So, and as always, we thank you and really appreciate this long-term partnership that we have. These are the goals and strategy points and initiatives we set forth at the beginning of the year. Some of these ongoing, and then others, to make sure that we're providing updates on significant items on an annual basis. As I talked about in the past, I take these and I slot certain things in for the different quarterly updates. So generally for this quarter, I give a quick update on data security, and then we have the standard reporting that's provided. So I'm not going to go through all of the detail here in the security overview. I did cover this pretty significantly last year. And for the most part, a lot of what we're doing holds, and we continue to look to improve and ensure that, we are protecting participant data with this multi-tiered approach, both from a front end security process, and that really means, anything coming in externally from folks trying to access their accounts, from an infrastructure, everything we're doing internally to protect the record keeping system and all the data that we have, and then on top of that, operational safeguards. You know, the one thing I'll point out, which I think is most significant, is that we do guarantee accounts. So we will reimburse participants for any unauthorized access to accounts and access to funds, you know, assuming that participants are following safe protocol. And, you know, knock on wood here, we have not had situations or issues with the city of Portsmouth. And in general, for pension plans, you know, once a payment is set up, it does take a lot of multi-steps for us to make changes to that from an individual. So those procedures are pretty tight. This is the host of all the front-end security systems we have in place to protect data. This goes back, you know, to what I just mentioned. If someone's looking to make a change, we have a multi-tiered that's a word I struggle with all the time, but folks have to authorize their information, you know, multi-touch confirms through mail, email, et cetera, calling into the phone center before we change things. And then, you know, we have a lot of systems in place that track phone calls, that listen to background noise, that look where system access is coming from and making sure it falls within the norms that we're seeing. And if we see things rise to a certain risk level, we will follow up on that. And then from an infrastructure, you know, again, just a lot of security systems in the background protecting data. And then we also have certifications from an ongoing procedural and audit standpoint. So, you know, you see these references to SOC 1, SOC 2, Type 2, all of those look at outside auditors coming in and kind of really digging in and reviewing our procedures, reviewing how we take transactions, you know, how we're documenting things and giving us feedback and ensuring that, you know, they're not coming up with any negative or concerning findings. And the good news is that they're not. So we continue to receive, you know, really strong responses there, and we can come out and provide these SOC certifications as needed. And then the last thing I'll mention here is, you know, we do sit on and help lead an oversight board, and this is in partnership with many other financial institutions and providers in the industry. So we were one of the initial organizations to reach out to look to form this group. And this is really, you know, a collection of all of these companies you see here that, you know, we count ourselves as competitors when it comes to business and the things that we do. But one of the things we definitely all join in together is ensuring that we are protecting data and individuals' accounts, you know, and we're happy to partner with all these groups to ensure that that takes place. All right, I've provided some updated information here from a plan statistic, participant or benefit activity. Again, I won't go through all of this. Some of this, you know, obviously Brian and Jim and folks have really dug into where the plan is from an investment standpoint. And then some of the participant activity, you know, from a status standpoint is commented on at the beginning of the meeting as well. But, you know, we continue to provide services to 685 individuals in fire and police, and then 371 now in the supplemental system. And really nothing stands out or jumps out here. It's pretty standard, moving along and, you know, adding new benefits and removing benefits when unfortunately, you know, there's a deceased individual. And then finally, and I guess the only other thing I'll say before I just give the quick highlights on the expense and revenue disclosure is, you know, obviously with the COVID-19 situation leading to the CARES Act, you know, a lot of provisions were passed through the CARES Act that impact retirement plans. The vast majority of that we have seen on the defined contribution side and on the 401k plans, and we've adapted very quickly to support those. You know, from a CARES Act perspective for pension plans, there really isn't anything at this point that's applicable to the frozen pension system that the board has. So, you know, if at any point anything does come through that we would see requiring an update, we'd be having those conversations with you. And then finally, you know, the last few pages here is I generally provide is our quarterly disclosure, which just gives you a sense of total expense to run the program. And as a reminder, moving left to right on this chart that you see here, you know, we're categorizing investment management expense. So that's what all the rolled up expense of the managers who are actually doing the work, such as Artisan and PIMCO and the other groups that have been referenced earlier, what their costs to manage the funds are, Greystone's costs, our costs for providing the services that we provide, this revenue sharing offset, as I've talked about in the past, that the plans, the system do receive a little bit of money back from the investment companies to offset some of this expense, which gets netted out. And then the remainder, you know, you see here roughly 56 basis points for each of the individual plans. You know, that gets billed out in different ways. So, you know, the Greystone invoice for their payment comes to us. We pay it from the trust, and then we pay out a quarterly, or we issue out a quarterly invoice that comes back as well and gets paid against the trust. And, you know, that detail is shown here a little bit more. Well, that's not helpful. You know, that just shows some of that information, but at the investment holding level. You know, as I mentioned in the past, Morgan Stanley and the work that Greystone and Morgan Stanley are doing on, you know, a lot of the specific and customized investment strategy, that's all held over at Morgan Stanley. So for this purpose, we group that together here and show that. Morgan Stanley does provide a blended expense ratio back to us so that we can incorporate that in to get to that 40 basis points of investment expense that I referenced on the prior slide. And that revenue sharing that I mentioned, so that's coming right now from that Lazard International Fund. So Lazard pays back a little bit in revenue sharing. You know, based on Brian's reference, it sounds like that holding may go away. So that 15 basis points of revenue sharing that has been coming into the plan will no longer happen. But, you know, ultimately it all nets out into the cost of the plan as all expenses are paid from the trust. So it won't have any impact on, you know, an expense from that standpoint.
Tom, let me just comment real quick on that. So to the extent that we make an investment to replace Lazard in a strategy that does not have revenue share, the investment management fee would be substantially reduced from what it is right now with Lazard. So on a net basis, the cost would go down to the city, even though you might lose, or the trust, even though we might lose that revenue share.
Yeah, because that net expense now is around 91 basis points for using the Lazard fund.
Yeah. And if I were to guess right now, in general, based on kind of what I know some of our other managers are doing, so we're paying 1.06% to Lazard. 15 basis points of that is revenue share. So on a net basis, it's 91. I think that's right. My guess would be we'd probably be in the 40 to 50 basis point range if we use a different manager. So substantially lower than the net we're paying right now.
And then on an ongoing basis, we coordinate with Morgan Stanley since, you know, they are holding significant portion of the portfolio, you know, to raise cash as needed for us to pay ongoing monthly benefits and other fees and expenses. And so we have a good relationship and a tight process there with our trust group and the Morgan Stanley team to handle that. So that's everything I have, Laura. Again, I wanted to move through that quickly just because we don't have anything significant to speak of. But the last thing I'll close with is historically, Andre will come in and present the annual valuation results in October. So that's a little off cycle for these quarterly investment meetings that I attend as well. I think we're going to try to hold to that schedule. So I know the October meeting has a date on the calendar. I don't have it offhand, but that's the meeting we will target for the annual valuation review. And that, again, that Andre will kind of lead that discussion. All right. So Laura, back to you. I think you're on mute.
Brian, wait a minute, while we're on this slide.
Yeah.
Brian, you still there? Brian?
Yes.
Artisan developing at 109 bips. Is there any way to negotiate that down or to get revenue sharing at the level we are at with them, particularly since we just gave them more money?
Well, this is, so it's a mutual fund. It's an institutional mutual fund. So there is no ability to reduce fees there.
Okay.
But this is the manager that's outperforming by 40 percentage points on a net fee basis.
Yeah.
So even after that higher fee, we're you know,
okay,
well ahead.
Just wanted to ask. Thank you.
Yep.
Okay, well, thank you, Tom, for leading us through all of this and for the technology support. It really did matter. And thank you, everybody, for participating.
Laura, before you adjourn, I would like to ask, did Mark Munson ever make it to this meeting?
He did. I'm not sure if he's on mic, but I saw a note saying he did attend.
I am here.
Yeah,
okay, I didn't hear you and I wanted to follow up. Thank you very much.
All right. Are there any other issues, agenda items that we don't have listed? If not, our next meeting is scheduled for September 10th, whether in person or virtual. You'll get a notice about that. And in the meanwhile, well, be safe. Love everybody that you can. And have a good day.
Y'all be safe too. Thank you very much.
Thanks, everybody. Take care.
Thank you.
Everybody.
Thank you,
Best wishes, Laura.
Tom, for organizing.
Yeah, no worries. I will share the recording.
Thank you.
Thank you.